Lesson 3: Accounting and Taxation. In this chapter, we'll discuss about basics of accounting and an overview of taxation. Basically, to use basic accounting software, you need not to be from the accounting background, but if you know the basic terms of accounting or the golden rules of accounting, then it will be beneficial in every aspect. Like it will be beneficial for operating busy also and for other business needs. For taxation, we'll discuss just an overview of taxation covering the VAT and the GST part. So first of all, we'll start with what is accounting. Accounting is the art of recording, classifying and summarizing transactions of the business in a prescribed format in order to use this information to take managerial decision and for smooth running of business. Basically, prime motive for doing any business is to earn profit, and to ascertain or know whether you have earned the profit or there is some loss, it is necessary that you record all the financial transactions of a period in a prescribed format. So accounting is very important and it is an inevitable part of any business. Next, we'll discuss certain general concepts upon which accounting is based. There are many accounting concepts, but here we'll discuss the most important three concepts, in which first is business entity concept. According to this concept, a business is a separate entity from its owner. For example, if Mr. ABC has created a business firm, then Mr. ABC and that firm are two different entities. Dual entity concept. This concept indicates that each transaction is recorded in two different accounts. Minimum in two accounts, maximum can be more than two. So, for example, if you have purchased machinery in cash, then you will increase the value in the machinery account and you'll decrease the value in the cash account. That is, you will debit the machinery account and credit the cash account. So, in each transaction, minimum two accounts are affected in accounting. Next is your accounting period concept. According to this concept, account for a business are to be prepared for a specific period. For example, a 12-month period starting from 1st January to 31st December. Accounting should always be maintained on an yearly basis starting from 1st January or 1st April or 1st July in certain countries. So from whichever country you trade, you need to follow the financial period of the same country that the country follows. Next is your golden rules of accounting. In accounting, we have to remember only the plus and the minus of a transaction. That is, in which account amount is to be added and from which account amount is to be subtracted. In layman language, when you give money to a person, you add money in that person's account, and when that person gives money back to you, then you subtract the amount from his account. This concept applies to accounting, but in accounting, instead of plus minus, we use the term debit and credit. So it seems very easy in which account amount is to be added and from which account amount is to be subtracted, but it seems a bit confusing which account is to be debited or which account is to be credited. For this, we'll discuss three golden rules of accounting. The golden rules of accounting are classified on the basis of account types. That is, first is your real account. The rule that follows for real account is debit what comes in and credit what goes out. Next is nominal account. The rule for nominal account is debit all expenses and losses, credit all incomes and gains. And the rule that applies for personal account is debit the receiver and credit the giver. If you learn these three golden rules of accounting by heart, then you will never face a problem in ascertaining that which account is to be debited and which account is to be credited. So these are the golden rules of accounting. We'll summarize. First is debit what comes in and credit what goes out. Second is debit all expenses losses and credit all incomes gains. And third is debit the receiver and credit the giver. Now we'll discuss certain basic accounting terms starting with debit credit. The term debit and credit refers to the addition to or subtraction from an account. Real account. Examples of real account are cash, goods, stock, furniture. Nominal account like salaries, interest, loan, profit and loss on sale of account. Then is personal account, which includes capital account, bank account, person's account like Ramlal and Sons, Shamlal and Sons. Then asset. Assets are resources owned by a company. It can be anything that enables a business to get profit. That is, the things, resources owned by a company and from which you are getting some profit, then those are your assets. Liability. A liability can be defined as something that a business owes to a third party in the form an obligation to pay, for example loan. That is, whenever you have an obligation, that is the amount you need to pay to somebody, then that is called your liability. Capital. Capital is the money that owners invest to start the business and can claim from the business. Income. Income is money received by a person or organization because of the efforts done. In other words, you can say that it is return on work or return on investment. That is the return or profit on the work you have done. Expense is the amount spent in order to produce or sell the goods and services which produce the revenue. And then is debtor and creditor. A debtor is a person or business concern that owes money to the company, and a creditor is a person or business concern to which the company owes money. That is the person to whom you have to give the money, and the person from whom you have to receive some money are your debtors and creditors. Then is taxation. There are different types of taxes levied in individual countries. In some countries VAT is prevalent, while in some countries GST is prevalent. In basic, taxation part is totally dependent on the country you have selected at the time of company creation. That is, BUSY will display different taxes and their rates as per the country you have selected at the time of company creation, that is, from the country from where you trade. However, all across world, majorly two types of taxes are followed, which are VAT and GST. So we'll have a brief overview of these two types of taxes, starting with VAT. VAT is value added tax. It is a consumption tax added to a product sale price. Each seller in the product chain includes a VAT charge on the buyer's invoice. It is charged as a percentage of prices, which means that the actual tax burden is visible at each stage in the production and distribution chain. VAT applies to all commercial activities involving production and distribution of goods. VAT is calculated as per tax credit method, in which there is a provision for setting off the tax paid at the time of purchase with the tax collected on the sale of goods. That means you can set off the tax paid at the time of purchase with the tax you have collected at the time of sale. So this is the concept of VAT. Next is GST, goods and services tax. It is a value-added tax levied on most goods and services sold for domestic consumption. GST is paid by consumer, but it is remitted to the government by the business selling the goods and services. Most countries with a GST have a single unified GST system, which means that a single rate is applied throughout the country. A country with a unified GST platform merges central taxes with state taxes like sale tax, entertainment tax, entry tax, luxury tax, and so on, and collects them as one single tax. These countries are virtually taxing everything at a single rate. GST is one indirect tax for the entire country. So this is all we have covered in this chapter, that is basics of accounting, 3 golden rules of accounting, basic accounting terms, and overview of taxation also, including VAT and GST. Hope after going through this chapter you are having a basic idea about the basic accounting terms and the golden rules of accounting. Thanks for watching. For more videos, subscribe to our YouTube channel.